Now, I just came back from a private client meeting. I was asked this question: are we going to be in a recession? Now, you're right here in this video right now because you're thinking also, if there's going to be a recession, should you start selling your stocks and should you start moving your equity positions out? Now, today I'll be sharing with you 3 key parts on what you should be considering in how to prepare for such a situation. If this interests you, continue watching on. Before we move on further, you should absolutely be clear that a recession does not equal to a stock market crash. Yes, back in 2008, the stock market came down and then there was a bad recession. But if you look back in this chart, on many occasions, a recession did not necessarily look the same as a stock market performance. Of course, you have been seeing some news, and I'll pull up some over here, on recession. Now, when there's smoke, there's definitely fire. And when news such as manufacturing contraction come about, there's real basis for it, and maybe a contributing factor is actually the US-China trade war. But beyond such news on recession, there's actually another news, which is the inverted yield curve. And this has gotten financial experts to be really worried, because in a lot of cases, this has been a very powerful predictor of recessions. Now, in a nutshell, what does this inverted yield curve mean? Imagine you go to a bank and you're looking for fixed deposit. Do you expect to get more interest on your 10-year fixed deposit than a 2-year fixed deposit? Most likely yes, right? But right now in the bond markets, 10-year bonds are actually giving less return per annum than a 2-year bond, which means people are willing to settle for something guaranteed for 10 years and get a lower average return per annum. And this has really been a very powerful indicator to tell people's sentiment of what they are expecting of the future. But again, a recession is not a market crash, and what we are going to focus on is actually what to do in a market crash. Recession can come and go, but a market crash is a real opportunity for you to grow your wealth. And I'll pull up a quick summary for you over here on what we'll be covering. The first thing that you should be doing is to keep your liabilities low. Now think of surviving a market crash as surviving war. In a war, you need food, you need ammunition to keep fighting, and it's the same like a market crash. In that situation, you need to really be able to survive first. And the first thing that you need to save yourself is to save yourself from big purchases, such as a big house, because that will bring on big liabilities to you and it's just going to bleed your cash flow. And in a market crash, and if it happens to be a recession, your income is going to be affected. Double whammy. So avoid that situation, avoid buying big purchases right now. The second thing that I'd like to suggest for you is actually to keep enough cash, 20 or 30% of your net worth in cash or low risk investments. How does this work out? If your net worth is 1 million, you should be keeping 200 or 300,000 in terms of cash or low risk instruments. If your net worth is 200,000, you should be keeping 40 or 60,000 in cash or low risk investments, because what happens when market comes crashing down, property prices come down. A 1 million value house can easily be selling at 800,000, and whoever is able to make a down payment for it is able to jump onto the market and buy that house, and when it recovers, definitely be back to its 1 million value in no time. Same with a stock price. A good bank such as DBS Bank in the market crash can become $10, and what you need is to have enough cash to move in and buy that company, that asset. And because when it recovers, you'll be much more than $10 and you're going to really double and triple your wealth. The third part that I'd like to suggest to you is to start a regular investing plan right away, especially if you have more cash than that 20 or 30%. Now, why is this important? Because when markets start coming down, it's very difficult to make a system that you are going to believe in place because everything is negative. It's much easier to set that system right now, such that you're going to be regularly investing, and when markets do indeed crash, you are really having that system to work for you. You're not going to be affected by the noise, you're just going to follow through. 2 years, everything will recover. So that is the better approach than to really hope that you have a good sense on when to actually time the market and go in. It's much better to have a regular investment plan right now set in place. So I hope you adopt these 3 principles that I've suggested for you on how to survive a market crash. And again, if you haven't subscribed, I'd like to invite you to click on the subscribe button, because I'll be launching videos every week on helping you improve your finances. And also click on the like button because it tells YouTube that this is a good video. So I'm Josh. I'll see you in a future video. Take care and goodbye.